Investment managers enjoyed a great year in 2012 as markets around the world rallied, and it looked like business as usual for the first quarter of 2013. But which managers and asset classes performed the best, and where are investors putting their money? David O Leary from Morningstar joins us to give us his insight. David, thanks for your time. Let's just begin top line by just looking broadly at where that performance was, and also in terms of those asset classes, where the money went and where the money flew from.
Sure. So, broadly speaking, equities outperformed fixed income. I think that's true in a lot of markets across the globe. It's true here in South Africa. Foreign equities actually outperformed domestic equities, and I think there's two things going on there. One is that the South African economy and the stock market here just didn't perform as well. Sort of very low single-digit returns over the first quarter. But the other aspect, aside from the foreign markets just outperforming, we saw, for example, the S&P 500 up about 10%. Was that the rand has depreciated significantly against various currencies, specifically the US dollar and the euro. And when you're a South African investor investing in foreign equities, that's going to help your return. So that added anywhere from 5 to 9%, depending on the currency you had exposure to. So those themes played out in the returns that we're seeing in these categories.
David, I just wanted to come in here and ask you just around the, obviously the equity component. You mentioned the rand's a big factor there. Is that a net win in terms of, when we look at benchmarking the performance of funds, certainly equity funds against the all-share index or the top 40 index, is it always a win if the rand depreciates over any period for the equities underlying that index?
Yeah, if those equities are denominated in a currency other than the rand, and the rand depreciates against that currency, then that directly impacts the return that you receive as an investor, because that unit trust takes your South African rand, has to purchase those foreign currencies to buy the stocks on those markets, and then at the end of the day, when you cap your measurement period or you take your money back, those stocks are sold, that currency is sold, and the rand is purchased again. So what happens to the rand in that intervening period has a very direct impact on the returns as an investor you experience.
Yeah. Can you break it down, David, if you can, in terms of the performance of those equity classes as well? Is it just those that were targeted at the foreign markets, or are we talking also here outperformance in terms of the resources sector?
Well, so the top performing category was just global equity, broad-based. The best performing fund in that category was Old Mutual Global Equity, which was just a very diversified global equity fund. It has exposure largely to the U.S. It sort of generally reflects the sort of the overall MSCI world, so you didn't really need to take huge bets if you were investing outside of South Africa to beat a lot of the South African domiciled funds, because most of them do have a very significant weighting to South African equities and fixed income.
David, I just wanted to get to your perspective there. Obviously, very interested to hear how the actively managed funds performed against the benchmark. Has it been a lot harder for them in the first quarter of this year in the domestic equity? Let's start there, in the domestic equity space, to beat benchmarks like the SWIX and the All Share?
I think anytime there's variability and volatility in the sources of return, even let's say for the South African market, there leaves opportunity for managers to exploit it. So there are quite a number of funds that didn't have too much trouble outperforming the all-share SWIX. There's the best performing fund, I think, in the domestic equity category was Indequity's domestic equity fund, which is sort of a quantitative-oriented fund, and that I think did about 8 or 9% in Q1. So. Because of the fact that you've got certain sectors within the South African market really outperforming others, resources was among the worst performing sectors. If you didn't have a big exposure to resources, it's not that hard to outperform, especially over the short term.
We just wanted to also just understand, besides the equity space, in the fixed income space, lots of, and we're talking bond funds here, lots of funds also benchmarked against an index which investors can get a passive alternative to. How did they go in that space?
Yeah, I think in the bond space it's harder, a lot harder to outperform the benchmark, largely because of fees and the fact that returns, expected returns on fixed income are significantly lower than in the equity space. And so, for example, if you're expecting or hoping for a 4 or 5% return from bonds, but you're paying 2% to an active fund to try to hurdle that, it's really tough for that fund to then try to generate 7% so that you net out 5%. So what we find is that in the fixed income space, it's certainly harder for an actively managed fund to beat the benchmark.
Yeah, but that's interesting, of course, David, because we do know that bonds last year were the top performing asset class. And so what we're seeing actually here is a reversal of that momentum that we saw last year, and now money swinging back into equities and performance coming along as well.
Yeah, so for I think what stands out on the fixed income side is that the return was sort of more like 1-2% on average. I think 1% in Q1, which is a dramatic pullback from last year, but it's certainly not an unreasonable return. There are some funds in that space up a couple percent quarter to date. If you extrapolated that going forward, that wouldn't be such a bad return at the end of the year, but in comparison to last year, it certainly looks far more modest, and I'm sure a lot of investors are disappointed with it.
David, perhaps you can give us a rundown on the balanced funds, and this is obviously a very hard one because when you evaluate the performance of a balanced fund, whether it be over a quarter or a year or more, you obviously have to take into account the degree of equity exposure in the portfolio. So even though you've classified balanced funds into different categories, you've got high equity, low equity, medium equity, etc. How do you go about assessing the performance of a balanced fund and essentially discounting the use of equity in that portfolio?
Well, I mean, you do need to, as you mentioned, subdivide them. So one of the ways that there's, broadly speaking, two types of balanced funds or allocation funds, whatever you like to call them. Those that have a very strategic asset mix where they identify up front that, generally speaking, they'll keep to some sort of predefined ratio between stocks and bonds, and that might be something like 75% stocks, 25% bonds, or 50-50. But the point is that they have a predetermined ratio that they stick pretty close to. Maybe they vary a little bit around that. The other are these tactical allocation funds where the manager very much is making an active decision to choose which asset classes they think will outperform and then allocate money to those. So the range in equity might go from 40% to 80% depending on the manager's expectations. And so you really need to group them based that way because the manager who has the ability to choose how much to go into stocks and bonds and can vary that, you'll want to hold it against him if he's only in 30% stocks and stocks do really well and he underperforms peers who have 70% in stocks. Well, that was his fault. He had a choice to be in stocks and chose not to take it because of an expectation that he or she had. So you really need to evaluate them in the context of funds that are run with similar mandates. And as you mentioned, it's such a big space and there's so many different types of funds, it can be a challenge.
Yeah. David, let's take the conversation back to where the money went and, the respect between the asset classes. As I said earlier, certainly there was a lot of money that was in bonds last year, but not as much as that went into equities. But performance was mixed because bonds outperformed equities. In this quarter, where did the money go? And perhaps we can also talk about the winners and the losers here.
Sure. So what we saw, generally speaking, was money coming out of equities, domestic equities specifically, quite significantly, and more money going into lower risk assets. And I think that's a reflection of just the general market. I don't think South Africa is particularly unique in that regard right now. Every time there's sort of a lot of volatility or there's uncertainty in the markets, you'll see investors do that unfortunately, they often get the timing wrong. But you saw money coming out of domestic equity, going into South African fixed income, and a lot of money is still going into the multi-asset classes. And I think that a lot of that has to do with the fact that those funds are able to, dampen the volatility by holding, by diversifying across different asset classes, and then that provides a smoother return to the investors, so that they're less likely to panic in a multi-asset class fund.
David, we also wanted to just talk about some of the firms that we're seeing the big inflows, and it seems from the Morningstar report that we're using that Coronation was one of the biggest receiver of funds during that period. Just take us through over a little bit longer what you've been seeing from the distribution of funds across the different investment managers.
Yeah, so I think Coronation was number one, which isn't a huge surprise because it's I think the largest, or if not the second largest, asset manager in South Africa. That's a trend that's been pretty consistent for some period of time now. They've done quite well. I think number two was, I don't have the numbers right in front of me, but I think number two was Stanlib. And Ned Group was up there as well. And Ned Group's really made a push in sort of the more recent years. After sort of completely overhauling, there was a merger of a few companies, and they completely overhauled their approach to the asset management industry, and it's paying off. I've spoken to Ned Group. I've evaluated some of their funds. It seems to me a pretty quality shop that's really making a strong push to sort of win investors' trust and to put out a quality product and brand. So I think that's sort of paying off for them.
Yeah. David, Warren and I were talking earlier about the absence of Allan Gray, and we weren't sure why it wasn't on that list, or perhaps this is a function of the times. Yeah,
Allan Gray was positive for the quarter according to our estimated flows, but it was pretty meager. And it's a good question. I'm not. I don't have my finger on the pulse of sort of the advisor space here, and where they're allocating assets and why. I know that Allan Gray has been a pretty respected name and brand, is obviously huge, but it might just be a victim of its own size and success. When you get to a certain point in assets, continuing that momentum gets increasingly difficult.
Just one final question, David, and perhaps you could just answer it as quickly as you can. We see these investment managers using soft closes to try and indicate that the funds that they're managing is too big, and it's detracting from their performance. A more cynical approach to it is that it's actually a marketing tool to get people to invest in the funds before it has a hard close, so to speak. What's your take on the use of soft closes in the industry?
Yeah, I agree with you. I mean, I think you have to be careful about them. I'm in favor of them if they're used properly, and trying to evaluate what's proper or not is difficult. But there are cases where most of the flows might be coming from a certain area of the market. For example, in the institutional space, and you close the fund to new institutional investors and still allow retail investors to buy the fund. Or, for example, existing investors can continue to top up their investment, but you won't take on new investors. So I think there are creative and constructive ways to soft cap, but I agree with you. Firms that use it as a marketing ploy, it really leaves a sour taste in your mouth, and I certainly wouldn't condone it.